Hello, fellow real estate enthusiasts. I'm Richard Montano, your host of The Loudest Silent Partner, the ultimate podcast for savvy investors who want to diversify their portfolio with passive investment opportunities. Join me as we unravel the secrets of successful real estate investing where knowledge meets profit. Whether you're a seasoned pro or just starting, we've got insights, news, and inspiring stories you need. Let's turn the page on your real estate investment journey together. This is The Loudest Silent Partner, where your investments speak volumes. Mr. E, the way I start all of our phone calls, right? Our long calls. So now I just convinced you to, or tricked you into coming to the podcast and do our long calls here on video. Right?
We do have some long calls, that's for sure.
Well, I appreciate you coming today and help us out with this. You know, we're our audience is silent partners, passive investors, and we want to try to give a little content, a little education for them to learn how to be a good passive investor, which is why we're called The Loudest Silent Partner. And so you and I have worked together for years. I don't know, but
it's got to be 15, 20. I don't know. I don't have it tallied up in front of me, but it's got to be 15 or 20 years. For sure.
Long time. Yeah. So you and I have been through a lot.
Yes, we have.
I've been through a lot, and you've watched me.
We've both been through a lot.
So there's a lot of things that we've done together that I think are really good learning points for people. And so I want to kind of touch on some of that with regards to like real estate and write-offs and expenses and things like that. You know, we've done multifamily deals, we've done flips, we've done new construction, we've done loans, we've done all kinds of stuff in our company. And you've helped us with the taxes and bookkeeping and accounting for all that stuff. And, you know, you've been a treasure for us. I mean, this entire time, I promise you, this has been like,
yeah, thank you.
Because when it comes down to, you know, counting the dollars, like, of course we all want to make money, but counting money and then on top of that, taking it to, you know, Uncle Sam and saving money at some point with taxes, you know, we need someone like you. And so you've been great for us in many ways. You've been a resource for me when I panicked late at night calling saying, what do I do? And then you've been there to guide me on, you know, even through an audit, right? We did go through an audit together once.
Yeah, absolutely.
And you crushed it.
We did okay. We came out okay.
Yeah. So, anyway, so, I mean, you've done a lot for us. And so, you know, I'd love for you to share with the audience, you know, who you are and what you guys do over at Class Advisors.
Yeah, absolutely. You're going to make me blush a little bit here, but I appreciate the words. But yeah, I've been in San Diego my whole life, you know, start there. Grew up in Escondido, went to San Diego State. So not going anywhere. I love San Diego, not going anywhere. But been a CPA since 2002. I think I got my license, if I remember right. And have been working mostly with small to medium-sized businesses, you know, ever since I got my license. Had a little tour of duty through PricewaterhouseCoopers and worked with some big, you know, utility type clients. Hated it. Got out of it as soon as I could because I couldn't stand working in that environment. But yeah, I think you were kind of probably one of my original clients. I would think back when I got into the small to medium sized business realm. And yeah, I also have my ABV, which is accreditation in business valuations. So we do business valuations. Started the current company that we're with in 2016, October 2016. It's called Class Advisors. Me and my partner, Chris, which you know Chris obviously well too. Good guy. We started the business back then, and we've been growing ever since. You know, growing ever since. It's kind of what we found is a lot of CPAs are retiring and not enough young people coming into the industry. So
yeah, well, and then on top of that too, I mean, you have a passion for it. I mean, you've been clear about your passion since college. Loving the numbers, you know, getting a degree in accounting, right? And now actually making that a profession. You're one of those few that took an early passion and made it a career, and you're still living it, loving it, enjoying it.
Yeah, absolutely. I mean, in college, I took my first accounting class, and that's when I realized, like, wow, this is something I enjoy. It just absolutely makes sense to me. You know, see a lot of the peers are, you know, accounting doesn't make sense to everyone, and that's fine. Everyone's got their own strengths. You know, I can't write my name legibly. You know what I mean? So it's kind of depends on what you can do. But accounting just made sense to me, and actually enjoy it. You know, I really do enjoy it. So I kind of made the change about my third year in college, and yeah, been doing it ever since. But like I said, a lot of young people, we don't have enough people coming in the industry. So if there's young people out there, get into accounting. It's a great field. You'll always have work. I promise you that. And you won't get rich, but you'll always have work. That's kind of what I've found.
Yeah. It's funny. I have a saying in the office where I tell when people talk about other people's commissions and, how much money are they making on the deal, things like that. I always say you can't get rich counting other people's money.
Yes.
But I guess it's true. You're saying it's true.
It's true. You got to do other things. But it keeps the lights on. That's for sure.
Well, awesome. That's great. So leaning into, the space that we've worked in, which is real estate, we've done a lot of multifamily. When I try to explain expenses and write-offs and what that actually means to the bottom line, I think a lot of our clients don't really understand all of it. So I want to, if you could kind of give me an understanding or give us an understanding of, what items for like a multifamily, as an example, what can we write off? What do you typically see? And and have you ever seen someone try to write off something that they shouldn't or can't? With no names.
Right. No, absolutely. Absolutely. So, the context of rental properties, whether we're talking multifamily or we're talking, single family residences, we're able to write off for the most part, our hard costs is what we're looking at. There's kind of 4 things when I'm kind of reviewing a tax return that I make sure we get in there that get forgotten a lot of times. One is if there's a loan on it, obviously mortgage interest, that's got to get in there. Okay.
But just the interest.
Just the interest is a write-off, and we can talk about why that is. But just the interest is definitely going to be on that the profit and loss for on the tax return. Insurance always should be on there, which gets left off more than it should. Property taxes is something that also gets left off from time to time. Those are the 3 things that should be on there. Typically, is what we're looking for. The 4th thing is depreciation, which I think we're going to probably talk about, get into that a little more. Depreciation is an expense that most properties have. Obviously, if they've lived out their depreciable lives, you're not going to have depreciation, but mostly you're going to see depreciation that you should be taking every year, depreciation deduction.
Yeah, and depreciation is an interesting one because depreciation, just the word, means value, going down. Appreciate, value going up, depreciate, value going down. And so I think it's interesting when I've had conversations with clients, I say things like, well, we have depreciation to thank for this, write-off. And they go, well, how much money did we lose? Or, how far did the value go down? I said, well, no, depreciation's different. Depreciation is a tax write-off that the government allows us to do for properties in operation. So, I'd love for you, if you could you kind of explain what depreciation is from the tax perspective?
Yeah, depreciation is great for taxes and saving taxes up front. If you think about an investment that you're making, if you invest $100,000 in Apple stock, for example, right, you're not going to get any depreciation on that stock. You are going to pay tax on whatever dividend that you receive from that company stock, which is fine, but no real tax benefit there. Whereas if you put $100,000 in depreciation, in a piece of real estate, we are able to take a depreciation on that $100,000 that you put in. So you're actually getting a deduction, whereas in other investments like the Apple stock I'm talking about, you're not getting that deduction. Okay. So how depreciate, you want me to go into the details of how depreciation works? Yeah. So if you look at it in the context of like a single family resident, residential real estate gets depreciated over 27 and a half years, essentially is how it works. Now you can't depreciate the whole purchase price of the single family resident. You have to break out the purchase between land and structure, essentially is what you have to do. You're able to depreciate the structure portion of it for that 27 and a half years, essentially. That's kind of the generic single family resident depreciation rules and how it works.
So that's the Uncle Sam's way of saying the lifespan of the sticks and bricks is for residential property is 27.5 years. So basically saying, and this is an imaginary number, because they obviously last longer than 27 and a half years.
Right.
But so the property is worth X at day one when you buy it. And then over the next 27.5 years, we're going to say you get to write off until it goes to zero.
Correct. And it's a straight line. Yeah. Okay. So you'll get a little bit every year. It's about the same amount every year that you're getting on that structure. Yeah. So that is essentially what they're saying. It's what they had to assign a life to it. The taxable, depreciable lives aren't always accurate. Like cell phones, for example, are 5 years is what I've seen. And cell phones don't last 5 years too, but people are buying those new ones every year.
Every year, every 2
I
years.
just got a new one, so I know they don't last 5 years. But they try to assign some sort of life to them and some sort of rules, so to speak.
Yeah. So, and that depreciation rule only applies, and just correct me, I'm just making a statement / question.
Sure.
Only applies to properties in operation.
True. Yes. If you're not actually physically actively renting out the property, then yes, you're not allowed to take depreciation on it.
Right. So you're not taking depreciation on a home that you live in, but a property where the same home that's rented out can be depreciated.
Exactly. A lot of these things that we're talking about writing off is only applying to rental properties, because the IRS treats them basically as a business at that point. Your home is not a business. It's not a rental property. There are other things you can write off on your home, but a lot of things we're talking about you can't with your personal residence. Yeah.
One tactic that I love to use, and that I do this, and I love sharing it with other clients and other investors, is cost segregation.
Oh yeah.
And so, as you mentioned, the key word you said earlier was straight line depreciation. Straight line depreciation means you got 27.5 years, or value at 27.5 years, and then straight line down to zero. Where cost segregation is segregating components of that sticks and bricks and depreciating each of those components at a different rate. Is that correct?
Correct. So yeah, kind of how the cost segregation study works, or a cost segregation works. So what we talked about before is if you buy a property without doing a cost segregation study, okay? A cost segregation study is basically you pay an engineer or an architect, I forget exactly what their title is, but you have to pay someone who the IRS considers an expert in that field, where they can actually take the building that you bought and separate it amongst the various components, okay? So you don't have to just take a 27.5-year depreciation on the whole structure. You can actually break out the air conditioning unit. You can break out the sidewalks, the parking lot, lights over the parking lot, the carpet that's in there. So it actually, in those things that I just mentioned, you can actually get a much quicker depreciation than the 27.5 years. So what it does is it does kind of speed up your tax deductions that you're able to take, which in a lot of situations is obviously very beneficial besides just saving taxes. A lot of times I'll have clients that they buy a building, it takes a large down payment. Well, Uncle Sam helps them finance that by doing a cost segregation study, getting a bunch of tax deductions up front, and helping out with the down payment that they just had to put down. So there's some good strategies with the cost segregation study for sure.
Yeah. So we do it on a regular basis with our clients in our investment properties because our investments typically are less than 10 years. So, what we've seen is that in cost segregation, you front load that depreciation, that write-off, in the first 7 to 10 years. So for us, it makes a lot of sense because we front load that because we're probably going to sell that property by 7 years, by 10 years.
Right. And your investors probably like the tax savings on all that as well, let alone just the horizon of the building that you're going to be owning it,
Yeah.
They probably like that up front.
Yeah.
The legal minimum, that's what they like to pay. I know that.
That's right. Well, there's this funny story that I've got this client, and he's been with me for probably 6-7 years. And you know who he is, but we're not going to use names. Okay. Every year, we send out a K-1 for the property. So his investment, he made a significant investment, and every year he gets cash flow from the asset. So it's producing cash. The property's doing well. We're paying expenses. We have a net proceeds that can go out to our investors, distributions. And then at the end of the year, we do our accounting and final taxes. Well, part of this is, this number that we put in there, this negative number is depreciation, right? So we get to write off another number beyond the actual expenses, right? And so the K1s typically are negative. That's sort of our goal, is to create those negative K1s. So this goes back to that question earlier about the taxable versus earned income. And so anyway, so every year he gets his K1. This guy, and I'm not joking, on schedule, every March, this guy reaches out, Rich, oh my gosh, I got a negative K1. The K1 says negative X amount of dollars. But you gave me this much. Do I have to give it back?
It's magic. It's magic.
It's magic, man. And I have to explain depreciation to him every year. And why? This K1 for him is actually a good thing. Mm-hmm. So, for me, in the real estate space, I love getting negative K1s because I can offset that with my income. I love it if you could share, what an investor can actually accomplish with that negative K1. And first of all, as the professional, can you ensure that investor that it's probably not a bad thing?
Right. Yeah. Yeah, no, absolutely. I mean, it's, real estate, that's not uncommon, if you're doing it right. I should say, it's not uncommon if you're doing it right. Because, depreciation, it's a non-cash deduction, and it's a definite possibility. It's not magic that we're talking about. It's the tax rules, which are convoluted, don't make sense a lot of times, but we use them to our advantage, kind of like you're doing, though that loss that comes through most likely is because of depreciation if we're talking about rental real estate. And there's other things like amortization of loan costs and things like that on the property. So there's definitely could be some other reasons there, but for the most part, it's probably depreciation that you're dealing with. Now, whether or not an investor can use that depreciation, or I'm sorry, not that depreciation, that loss that you're giving them on that K1 kind of depends on their situation, okay? Because that loss from a rental property like that kind of has its own tax rules and whether or not someone can use that loss, okay? So one thing that you definitely will be able to use it would be to offset other passive income that you have, or non-earned income, non-W-2 income, non-business income, that type of thing. So if you have other passive income, like other rents from other properties, that loss will come through and help offset that. So it's a good thing. If you don't have any other passive income and you're not a certain classification with the IRS, you're probably going to have that loss carry forward and offset future income is typically how it would work. So whether or not it's doing that loss is able to be used on their return depends on their situation.
Are they able to, let's say they can't take the total loss, right? Because they've, their earned income, their situation, their status, et cetera. Can they take a certain amount of that passive loss and offset with their earned income?
So yeah, if they are completely passive, then whatever the loss, and they don't have any other passive income, then that loss would get carried forward into the future. It never goes away. You don't lose it until a couple of things, one of two things could happen. Either you sell that investment and then the loss comes through at that point, or you have other passive income that you could use it against, essentially, is the two ways. Now, if we're getting into rental loss rules, there are some other things. If you actively participate, meaning putting a certain amount of hours into the rental property, and your income's under a certain point, then you would be able to use that rental loss.
Okay.
So it kind of just, like I said, there's a lot of different rules that go into it. And I don't know how much in the weeds you want to get into that, but yeah, in a lot of situations, if you're not able to use it, you don't lose it. You will use it eventually. At some point, that loss will be a benefit for you.
Okay. So to take all that loss, you have to have, you said there's a certain designation or something. I forget the word.
Well, there's a few designations. What we were talking about earlier was the real estate professional rules that the IRS has. Okay, and we can talk about that in a little more detail. There's also the active participation rules, essentially, meaning which they're pretty easy to meet those rules. And I usually take it with most of my clients. We'll have that rental loss come through if their income has to be under a certain point, though, okay. Which is $150,000 of adjusted gross income. So
is that per individual or
that's on a single return or a married filing joint return, which isn't fair, but that's the way the IRS sets it up. Whether you're single or you're married, that $150,000 AGI rule kind of comes into play, is what it is. So if you get over $150,000, you cannot use any of your rental losses unless you're a real estate professional, is how the rules work.
Okay.
Now it's not an all, and it's actually kind of a phase out thing. So once your income hits $100,000, it's a 2-to-1 phase out. So once you reach that $150,000, you're essentially able to take zero. If you get halfway there, between the two, you can take half of $25,000. Essentially, is how it is. So it depends on your income. Most of my clients, especially here in California, the rules are the same for here in California as they are for someone in Kansas, which, of course, our incomes aren't the same. So it's not really fair. But most of my clients in California have their income over $150,000. So they're not able to really take advantage of a lot of these rental losses,
So then that kind of leads me into the next question, which is what if you have a stay-at-home parent and that person is active in their real estate portfolio. That person is active managing the property managers. They're, maybe doing some maintenance, things like that. But they're active in that as well as being a homemaker. Mm-hmm. Could that person be considered a real estate professional?
Yeah, absolutely. So how the real estate professional rules work is that you have to meet a couple of different tests, essentially is what it is, okay? You have to have a certain amount of hours first in what the IRS deems as real estate transactions, okay? That could be, and they have a list out there. I mean, property management, like you mentioned, is definitely in there. Real estate agents would definitely qualify. You have to be self-employed, essentially, is another thing. Construction contractors, they qualify as real estate professionals. Are considered to be in that real estate realm, is what it is. And how the rules work is you have to have 750 hours in a year, and that 750 hours has to be more than your hours spent in other activities. Okay. Mm-hmm. So to kind of make it more clear, for me, I spend 70 hours a week doing accounting, right? So technically I would, for me to be a real estate professional, I would have to spend more than 70 hours a week doing real estate transactions, which is not possible. It's really not possible. Yeah. I work my maximum already, so I'm not able to do that. The IRS said, we've gone through audits on this. The IRS has kind of said, if you have another full-time job, we're not going to allow you to be a real estate professional because we don't believe you work 80 hours in real estate and your other job. Yes, essentially how it is. So to your point, if you have a spouse that is, not working from home, but a homemaker, taking care of the kids, as long as they can show that they spent 750 hours doing property management, for example. If you have your own rental properties, if your wife is doing your wife or husband, the spouse that's not working is doing the managing of those properties. If you can show that you spent 750 hours, then you would qualify. You qualify as a real estate professional. So it's kind of a little loophole that gets missed a lot, honestly.
And I mean, one of the key things I didn't hear you say was that you need a license.
You don't need a license. Yeah. I mean, would that help in an audit? I suppose it would. It shows that you are in the real estate business, but technically it doesn't say that you need a license to be a real estate professional.
That's interesting.
Yeah.
So that person, that stay-at-home spouse, is now able to prove that they're a real estate professional. They've got assets that have, negative, taxable income, and maybe they're even getting K-1s that are negative. So now that joint tax return, are they able to have unlimited losses for that year?
Yeah, there's no limit on those losses on the real estate professional if you qualify. Yeah, so it's unlimited. That is true. Now, keep in mind, we're just talking about the federal rules, okay?
Yes.
So we're in California here. California does not conform to the real estate professional rules. So you would actually have an adjustment from any rental losses you took on the federal return, which, like you said, are unlimited. You'd have to adjust those out when you're actually calculating your California taxable income. So keep that in mind. Everything we're talking about here is federal, but yes, the federal rules say it's unlimited. Yeah, so you could have a huge $200,000 loss of rental losses come through if you have the K-1 to justify it.
Yep. Wow. Okay. So we have investors who, the doctors, attorneys, and CPAs, and different professions that invest with us, and they trust me to operate a business and get income and then handle the accounting and taxes at the end of the year. So we give them a K-1 in March. What happens for them that beyond being like a real estate professional? Are they able to? Is there anything else they can do to be creative with their write-offs or taxable income for their personal return?
Talking about just that K-1 with the loss on it that you're receiving?
Yeah, so they've now received it from us, and now they've got other things going on. We've talked about how they can potentially be a real estate professional, things like that. So is there anything else that they can be creative with?
Yeah, so if we already decided they can't be a real estate professional, and they're they're not in that industry, but you are able to offset still other passive incomes that are coming. So if you can get some other passive income coming in, then it would help offset that, is how it would work. Now, investment income is not considered passive income. Investment income is its own animal. Okay. So like dividends that you're getting off of stock or a portfolio that the stock portfolio that you may have, that's not included in the passive income bucket, so to speak. Okay. So the rental loss will not offset that type of investment income like that. So you're really looking for passive investments that it would be able to go against. Even if you're investing passively in another business, for example, that would also qualify, if we have income coming from that other business or other rents, other properties, it would definitely offset other rental properties that you have, other rental property income from those properties.
Okay. All right. That makes sense. Now, we had a client who had a cash event. They sold a property and they had a huge capital gains. And so their capital gains tax was one issue. But the issue that came up for them, and this is the question they brought to me, was does their tax bracket change for all of their income because of this one, large sum of money coming in that year?
Yeah, if we're just talking about long-term capital gains, then again, we're talking about for federal purposes.
Yeah.
California does not have a long-term preferential tax rate. But it doesn't really change your ordinary income tax bracket, where you hear about the 12, the 22, 30,
right,
and all the way up. Because that long-term cap gain is capped at 20%, essentially, is what is once you reach the highest tax bracket. For the most of it, for most people, you're probably going to be paying 15%, which is the federal cap rate. It doesn't affect your ordinary income tax rates, essentially, is what it doesn't, which is kind of nice, So if you only make $50,000 as a W-2, for example, you're still going to be paying those lower ordinary income tax rates. Thankfully, you're not going to get shot up into the highest tax bracket that you'd have to pay on that W-2, which you wouldn't have had to do otherwise. So that is kind of nice. It kind of preserves your lower tax brackets. It's kind of nice. Yeah.
Yeah. I think about that sometimes where, there's a big exit, that happens like once in a blue moon for certain people. And so they make, $100,000, investment or return, and that they're going to pay 15% on that $100K.
Right.
And their $50,000 in your example, their $50,000 income is still going to be taxed the same ordinary income rate.
It should, yes, absolutely.
Yeah, that's good.
They're doing it properly. That's the way it should. That's the way it should roll out. So it doesn't push your other income into those higher tax rates. Thankfully, yeah,
good.
It is. It's nice to take advantage of that. and another thing, just kind of getting back to what you're saying, if you do have a sale of rental income, a sale of a rental property, like you're talking about, if you do have any other built-up rental losses from other properties, all those losses will come through and help offset that gain as well, which gets missed a lot of times too. So that's something that I have seen on returns where, for whatever reason, those losses from other properties were not freed up when you did have a capital gain from another rental property. So, those capital loss carryovers are actually pretty valuable down the road, and they pop up, and they're good to have for sure.
Yeah, we've had a few.
Yeah, absolutely.
And I say we as in like you and me, because we went through that together.